All right, good afternoon, and thank you for joining us today. My name is Natalie Wolf. I'm the Director of Investments at Foundation for the Carolinas, and on behalf of the executive leadership team at FFTC, we thank you for joining us today. If at any time during the webinar you have questions or would like further clarification on a specific topic, we invite you to post your questions in the chat. The Mercer team will address these after the presentation during the Q&A portion of the webinar. If we do not get to your question during the session, we will follow up with you after the webinar. This webinar is being recorded and the link will be added to the fftc.org website, and you can access it by going to menu and the link is under Engage Events and Webinars. I will now introduce Travis Pruitt and Tim Westrich. Travis will be leading the discussion and will address market conditions and investment performance for FFTC's investment pools during the first quarter of 2026. And I will hand it over to Travis.
Great. Thanks, Natalie, and welcome everyone. Thanks again for joining us. I'd also like to briefly introduce our colleague, Jane Sagalovich, and we're going to talk about hedge funds today as our special topic. And so she's going to lead the discussion on that, on what is, I think, our first guest spot. So we're excited for that conversation. So thank you again today. We will briefly go back through the first quarter, and I will save you through. I will also help over that hump with updated performance through April and May. We've been on a bit of a yo-yo string, and so we will talk about a bit more than just the end of the quarter because the world's changed quite a bit over the first 4.5 months of this year. Then we'll spend some time talking about hedge funds as a class and that's how we use them on your behalf. And then as always, we'll touch on standard pool performance at the end, and we'll take any questions. So do please, if you have questions, drop them into the Q&A function on the Zoom. So let's start with market performance. So as I mentioned, we have been on a bit of a yo-yo string for the better part of 17 or 18 months. We did see global equities go down in the first quarter, but it's really episodic to March. Through the first 2 months of the year, the public market returns were very strong. Equity markets, particularly those outside the US, both developed and emerging markets, generated really pretty solid returns. But inside the US, in March, with the onset of military activities in the Middle East, the market took risk back off the table. And so we saw the global equity market down about 3%. US equities, which had trailed through January and February versus non-US equities, also performed less well over the whole course of the quarter. We also saw a bit of rotational leadership through the period where we did see a continuation of smaller cap stocks and some value orientation perform well in the first quarter. But much of that activity was through the end of February was a continuation of what we saw in market activity since about the middle of October, where the market broadened out, where we saw meaningful performance leadership away from just the largest AI-oriented, growth-oriented stocks in the US. And we can see that those types of names here, as typified by the down 9.5%, did underperform in that first quarter period. Since the end of the quarter, we've seen that rotation flip back the other way. And through April and in the first week or so of May, we did see investors more focused on higher growth expectation stocks, those stocks in the AI universe or in the AI environment. Both technology as well as other tertiary components perform really pretty well. And so we have seen leadership flip back and forth. But generally speaking, I'll run through the numbers here in a second, but the markets are up, and we're actually up and recovered through the end of April. And as I mentioned, emerging markets was the best performing sort of bigger category in terms of downside performance, basically flat for the quarter, as those markets had generated significant upside return through the first 2 months of the year, and then gave much of that back with the correction in March. Much of what was driving the story, of course, particularly beginning with the onset of war right at the end of February, was the price of oil and the impact of overall commodity trading and delivery around the world. And so we saw natural resource equities and commodities up a lot in a short period of time. Those tend to be very volatile, and we've continued to see that volatility as the story, as the news coming out of Washington and the news in terms of potential peace has moved around. We have seen those numbers move around as well. In an environment like we saw, we might normally expect there to be a bigger flight to quality in terms of treasuries, but actually the yield curve itself steepened, which means that longer term interest rates did go up. So while that left, fortunately now with some income yield from bonds in this higher interest rate environment, that meant basically a flat return for investment grade bonds and slightly negatives in terms of longer maturity debt. And then with a risk off posture, things like high yield and leverage loans also were off modestly for the quarter. Excuse me. But trailing year over year, the numbers are still really robust. And as we think about the 1 year period, save for a couple weeks in April, much of the 1 year period has been largely straight up. Global equities up 20%, emerging markets leading the way at up nearly 30. Some of that outperformance by emerging as well as developed markets has been as a result of the dollar weakening. Dollar strengthened a bit here with the onset of military action, but it has softened up in the last week or so. So we are still seeing some really pretty solid returns year to date over the 1 year for non-U.S. markets. And of course, U.S. equities just continue to roll along. So as example, whereas the U.S. equities we measure here is the S&P 500, and through March it was down 4. Through yesterday it is up 14% for the quarter and up 9% year to date. So that's just emblematic of the recovery that we've seen. And again, this notion of a yo-yo string, or perhaps one of those basher balls with the rubber band and the red ball. That's the motion that we're getting right now. There's a fair amount of volatility, but right now we are on a bit of an upswing. Yields, as I mentioned, because there's a fair amount of yield income now, as we, from the interest rate shift we saw way back in 2022, yield curve environment has been relatively stable, and we've been able to generate a return over the trailing year that's about the current yield of the Lehman aggregate. So all in all, markets have rebounded. There is still a fair amount of uncertainty, but the market seems to be looking over the chasm of Hormuz and Middle East activity. We'll continue to see as that waits to be resolved what happens. But being diversified, remaining diversified, we think makes a lot of sense here, as we would expect the story of continued volatility to be at the forefront. So we'll leave the market overview and we'll jump into the conversation on hedge funds. And in the Foundation for the Carolinas complex, the place where there is exposure to hedge funds is in a diversified long-term growth standard pool. And we use this strategy as part of our lower risk allocation in the portfolio. So if you think about the pie chart we have up on the page, private real assets, private equity, and public equity, those are really the drivers we look for to drive most of the upside return over time, or the higher expected return over time in your portfolios. And then we use public fixed income hedge funds and private debt as an offset to those, or as a diversifier to those, to try to provide ballast when equity markets aren't performing well. Basically, as we try to generate as an optimal of return as possible on the upside, while also trying to do that with as much consistency as possible, as much management of downside risk. So that is a key part of how we think about using hedge funds. Our view is not everyone's view on hedge funds. Some people do use different types of hedge fund strategies, perhaps to try to outperform equity markets. That's a pretty challenging game to play, but there are some folks that take that approach. Others use a different mix of strategies than Jane will describe to you as we go forward. And so it's important to realize that hedge funds are not necessarily an asset class, but we use them like an asset class. We use them as an asset class type tool to deliver important characteristics to your portfolio. And so for hedge funds in general, we generally want to get better than bond returns. So we aren't trying to beat the stock market with these. We want to get bond-like volatility. So these are not bonds. So they won't have just bond vol, but we want to have volatility. We want to have short-term action that's similar to bonds over time, but we do want them to have a lower correlation, that is lower sensitivity to all the other asset class things that we do, because that's part of what makes them a strong diversifier. And so We think of them as a holding in lieu of fixed income. So we do want to do better than fixed income over time for performance, but we want to have risk controlled. And we do that, as Jane will walk through, we do that by combining a number of different types of market exposures and investment strategies and investment techniques that allow us to pursue that return and diversification objectives that I just touched on. So with that, I will again like to just reintroduce Jane Segelovich. She's a member of our hedge fund team. She works closely with our global CIO for hedge funds, who's responsible for your portfolio. Jane, with that, I will pass it on to you.
Awesome. Thank you, Travis. And thank you everyone who joined us today or is watching the replay. So I know that markets have felt pretty headline driven lately. And in periods like that, it could be helpful to understand which parts of your portfolio are meant to be those stabilizers and what they're actually designed to do. So here's the simple lens for today. The hedge fund allocation aims to provide an absolute return profile and diversify both equity and interest rate risk, like Travis mentioned. Just to set the expectation, they're not meant to be exciting. They're meant to be steady and really almost boring by design. So the overall portfolio can feel more durable when markets are stressful. So how do they actually do that? Let's start with one quick misconception that Travis actually already did mention that clears up a lot. A lot of people hear hedge funds and assume it's an asset class like stocks or bonds, and it's actually not. The way we like to think of hedge funds is more of a way of investing with a common thread of flexibility and active decision making. Now, there are three main levers that managers can seek to pull alpha. The first one is unconstrained strategies. They're not stuck in any one style box. Another one is alternative risk and return drivers. The results don't have to come from the same stock and bond story. The third one is a broader toolkit. So they could do things like hedging, longs and shorts. They can adjust exposure and really be more deliberate about where they can take risk and find that additional alpha. And when all those levers come together, that's when you can see skill really show up in returns, and that's the alpha circle. And this is what brings us to what really drives the experience, the strategies that our managers use and how they combine them. So what's inside the actual toolkit? Managers use different building blocks for different jobs, and different jobs matter at different times. First, we have multi-strategy managers. This is the steady bucket. The goal is returns that don't need a clean, obvious market direction to work. More about pricing gaps, spreads, and specific catalysts. So ideally, you're not waking up feeling like you have to guess what the S&P is going to do that day. Consistently useful, but not necessarily exciting. Next, we have security selection strategies. Now, while skill matters across all approaches, this is where skill is most obviously expressed as picking winners and losers. Managers are trying to get paid for being right on specific companies or credits, not just riding the market. It can add meaningful value over time. It can also be the most humbling category when markets get chaotic, because when correlations spike, fundamentals can really get drowned out in the short run. Our third bucket here is diversifying strategies. This is the shock absorber. These are the strategies you tend to appreciate most when markets dislocate, when the usual relationship breaks, when things gap, when risk gets repriced all at once. In a smooth equity rally, they can really feel like a drag on portfolio returns, but then volatility hits and their value becomes much more obvious. And the punchline here is we're not buying any one hedge fund or any one strategy. We're building a mix so the allocation can keep doing its job across different market moves. So here's what that has tended to look like over the past couple of decades versus stocks and bonds. Now, on this slide, we're using broad hedge fund benchmark data to show the typical relationship to stocks and bonds and what it's looked like in drawdowns. So on this chart here, you can see we're looking at beta, which is really just a fancy word for sensitivity. Each pair of bars is basically asking how much did hedge funds move with stocks and how much did they move with bonds. Bars close to zero mean it didn't move that much with the market. And what you could see here is hedge funds sit close to zero on both, and they're that very bar on the very right there. So looking back, they've tended to be less tied to both equity and interest rate moves, and that's why we call hedge funds a true diversifier. So that's the day-to-day relationship that they have with stocks and bonds. Now, let's shift to the real test. What happens during market stress? Here you can see major equity drawdowns. And the dark blue here is your global equities. Light blue is the traditional 60-40 mix, and gold is the hedge fund composite. What you could see here is in equity drawdowns, hedge funds tended to fall less than a traditional 60-40, not zero losses, just a more defensive shape when equities are under pressure. On the bottom right here, these are the major bond drawdowns over the past couple of decades. You can see bonds in the blue represented by the Bloomberg Aggregate Bond Index. Here too, hedge funds have tended to be more defensive. And that matters because there can be periods, like the one we have been in since 2021, where bonds are not the ballast against equity drawdowns that people got used to them being. So those additional diversifiers can be important. So to summarize, in severe sell-offs over the past couple of decades, hedge funds have tended to cut peak losses and improve downside outcomes versus a traditional 60-40, which can help support staying on track when it matters most. So we mentioned the importance of building a portfolio and not just looking at any one strategy or any one manager. And so how do we build a portfolio that's able to provide all those benefits? The absolute returns, the diversification, and the downside protection. The portfolio construction and implementation is the difference between a well-built diversifier and an expensive disappointment. A lot of disappointment with hedge funds historically has come from how they are implemented. If you buy a handful of funds and you don't diversify and you don't do the deep due diligence, you can end up with something that's basically equity beta and skies and hedge fund fees, and occasionally with the kind of blowups that make the headlines. So when someone tells me they tried hedge funds and it didn't work, my first question always is, what did you actually own and how was it put together? Because with hedge funds, how you build matters more than just what you buy. So our philosophy is intentionally simple. Our North Star is risk reduction. We're not using hedge funds to chase the next hot return stream. We're using them to aim to make the overall portfolio more resilient, especially when markets get messy like they did last quarter. So we start with a very clear job description. First, a cash plus return objective. Think T-bills plus about 3 to 4%, net of all fees over a full market cycle. Second is low equity sensitivity, roughly 0.2 equity beta and about 1/3 of the volatility of equities. Third is minimal interest rate sensitivity, effectively near zero beta to core fixed income. So we're not just swapping one type of rate exposure for another. And less participation in equity drawdowns, in an asymmetric profile where we participate more in the up markets than we do in the down markets. We also want exposure balanced across the strategies, so we're not dependent on any one market environment. Finally, it's important to diversify across roughly 12 to 18 funds to reduce idiosyncratic manager risk. That multi-manager design is a big deal. It can help reduce the chance that any one manager, any one trade, or any one style dominates the outcome or the headlines. So with that lens, let's look at an example of what a purpose-built, diversified hedge fund program has looked like in practice. Now, a quick reminder that this is past performance and may not be indicative of future results. So you could see here on this chart, the dark blue line is Mercer's illustrative track record. This is an equal weighted composite of portfolios in diversified hedge fund programs managed to this approach we just discussed. Again, net of all fees, and this track record goes all the way back to 2005. So we got quite a long time frame here, so you can really see what hedge funds do over time. Now, I want you to look at the solid gray line here, which is the Bloomberg Aggregate Bond Index. Again, the same one we used a couple of slides back, which is our stand-in for fixed income. Now, we use bonds as a reference point because under this philosophy, hedge fund allocations are often funded from fixed income. They use a similar risk budget, but with the potential for better diversification and a return premium over time. Now, you can see on this chart how that premium, the gap between the gray line and the dark blue line, and over long periods of time, that gap has really compounded. Now, the other thing worth noting on this chart is how closely the return, that dark blue Mercer line, has tracked the cash plus 4 objective. That's the gold line you see there. And this was made possible by sticking to our philosophy, having stringent diligence in manager selection, and using thoughtful implementation. So you can see this performance story again in the table on the right. In the top row, you can see 5.7% annualized for the hedge fund program versus 3.2% for the bond index over the time period. And that was achieved alongside the diversification profile we've been talking about. the 0.2 beta to equities and the 0.1 to fixed income, with a smaller max drawdown and more positive ments. So taken together, this is the profile we're looking for when hedge funds are used as a diversifier. Not flashy, resilient, and additive over time. So before I wrap up, just want to anchor us in 3 practical points. First one, what success looks like. We seek to deliver cash plus returns with low equity beta and low interest rate sensitivity, not to beat equities. Second is the trade-off. In a strong, smooth equity rally, hedge funds can look boring, and that's okay. Their job is resilience, not excitement. And then third, the build matters. Diversification, risk limits, and deep due diligence are what gives you the best chance that hedge funds behave like a true diversifier and not just an expensive surprise in your portfolio. So with that, I'll hand it back to Travis.
Great. Thank you, Jane. That was fantastic. And the compliance person in me will highlight that if you're watching online or you have a chance to look at our disclosures about our history, that was great, and hopefully that was informative for everyone. That was a really great tour, Jane, through the hedge fund environment. And if you have questions, certainly today at the end of the call, we'll be happy to take those. Or if you have other questions, if you're listening later, certainly funnel those through your FFTC contacts with Natalie and her team, and we'd be happy to address them. So with that, we will progress to standard pool performance for the quarter. Again, with all the excitement in March and the drawdown in the markets, the outcomes for the quarter were actually rather demure on the downside. So we talk about our most conservative portfolios, like reserves and low duration, did generate positive results for the quarter on the back of strong results over 2025. Again, yield curve steepened a bit, but that was primarily impacting intermediate and longer term duration fixed income. So good results from our low duration strategies, basically in line with benchmark over the first quarterly period. The longer term oriented pools, including income and growth, which is 40% equity, they did have modest drawdowns for the public only pools. But again, given the size of the drawdown in March, well, I think probably many investors probably thought that the results would actually be worse. And you know, in a diversified longer term portfolio structure, these downturns for a quarter are pretty reasonable in our assessment, at least in terms of the absolute returns. So our 2 longest oriented funds, passive long-term growth and active long-term growth in public markets, down around 2% for the quarter. A little bit of active outperformance in a pretty rocky period. Much of it generated during January and February as the market stayed broader. When we look at the diversified long-term growth pool, that level of diversification, which includes both the hedge funds that Jane just talked about, as well as private markets, helped to support capital a little bit better in this quarter. As we've seen through previous calendar years in markets where equity markets are very strong, when the public markets are very directional, the diversified long-term growth tends to not keep up as well, and that certainly was the case in 2025. But the added level of diversification helps it survive and compound through down quarters like we saw here, to where picked up a couple of 100 basis points of relative return versus the public only. So they're as different tools, they provide different ride and a different structure to really try and grow your charitable assets as you move forward. Just in terms of the ESG index, ESG portfolio did underperform just a bit more than the others in the quarter. That driven primarily due to energy exposure. So our ESG strategy does tend to be very light on energy and energy related assets, and certainly in a period of time where price of oil accelerates quickly in terms of value, those stocks followed suit, and that's the primary driver as to why underperformance here in the ESG for the quarter. So that is, we were briefer this time, so hopefully we got lots of questions. That's the end of our prepared comments, but we'd love to take any questions from the group or from the team.
Please put any questions in the chat and we will respond. Wait a minute. Also questions, since we coming off not a great March. Can you let us know what happened in April and what you see potentially going forward in the markets right now?
Sure. So just as we have the April numbers, and May will continue on this trend, but all of the standard pools were positive calendar year to date through the end of April. So the recovery was really pretty significant off of those March lows, and it's following a pattern we've seen a fair amount here with news flow. That's oftentimes the news flow is dramatic into the downside, and then market participants take a breath and start to look across the chasm. And that feels again like what we've seen through much of April and into May, as investors are beginning to look past the conflict around the Strait of Hormuz and the impact to energy markets and other global markets, and are committing capital to equity securities. Much of that has been, again, through much of March and all of April, much of that has been back towards the more speculative part of the marketplace. So the AI ecosystem, we're seeing it in large cap stocks. We're also seeing the same kind of divergence in small cap stocks that we saw through the middle of last year, where there's a much more focus on higher expectation names. That some information for that value for that does suggest that perhaps investors are a bit concerned about the general economic environment, so they are refocusing into the types of companies that perhaps can grow regardless of market environment. We see that periodically, certainly in the aftermath of the tariff implementation last year and the unknowable or unknown impact of that. We did see investors also, recommit to more speculative, maybe higher growth expectation stocks, and so that means that companies that are a little bit higher quality maybe have stronger balance sheets or maybe more consistent but slower growth rates. Those stocks tend to underperform in those kinds of environments, and we'll see some of that in our portfolio performance, certainly for April, but hopefully not for the full year. Our hope is that the market begins to broaden back out. Some of those speculative names or ecosystems perhaps have gotten ahead of themselves. There are very high expectations built into those stocks. Seems like every day the AI capex number gets expanded. It's now, the last number I saw was 800 billion was the AI capex number for the top hyperscalers. That's a tremendous amount of money and larger than the GDP of several countries around the world. And that is built on expectations for usage. So those security prices reflect those expectations. And to the extent that any of those expectations come up short, they don't even necessarily have to be negative in terms of growth, just maybe not as much growth or not as strong execution as are built into those. We could see those names roll over and sell off. And that will have a disproportionate effect on the index level measurements just because of the capitalization of those companies. So I think there is some risk, but the question is always, what's that last grain of sand going to be that causes the sand pile to roll over, and when will it come? And we don't necessarily have concrete views or an uncloudy crystal ball on that notion. But right now the market does continue to seem to be comfortable bidding on the notion that we'll get past this military intervention and that we'll move back into some period of peace, and that we'll be able to move quickly enough to move on, I guess, to the next stage of normality with such a pace that it doesn't cause a major economic downturn globally. That the one sort of remaining item around that is just the length of time that energy takes to get from the Strait of Hormuz to where it's going. And those are 6+ week kind of journeys. And so I guess we're a little bit past it now, but the ships that left before the military action at the end of February only recently arrived at their destinations. And so everything for the last 6 weeks, by and large, has been stuck in the Persian Gulf. And so there might not be a full recognition of what that time gap means, even if we resolve these pretty quickly. So that could be another factor we think that could contribute to volatility. for the next few months. But the investors seem to be, by and large, across the marketplace, seem to be looking over that chasm and thinking about what's next. So hopefully there, the broader markets optimism is realized, and that we can experience these and see broader economic growth continue as perhaps was anticipated by the returns we saw in January and February.
There's also a uptick in inflation. Can you comment on that, and also anything about the new Fed chair?
So inflation has the makings. On the one hand, I'll be an economist here for a second, with no offense shown to any economists that might be on the call, but there is always two hands. So on the one hand, there are components that suggest we could see continued higher levels of inflation, in part because energy goes into everything, and oil as a feedstock goes into a lot of things as well. That where it's not consumed as energy. So plastics is a key. Oil is a key contribution to the production of plastics. And when you think about all the plastic things that we use globally, that can have, if you figure, the packaging on your water bottle, the plastic wrap that goes over the chicken that you buy at the grocery store, these are potentially insidious things that could press, that will either, or perhaps both, either press for higher inflation or compress earnings where firms are less willing to pass along their price, their cost inputs, or both. We see both inflation, and we see some compression in earnings because they can't pass along the entire cost. So I think those are some things that are still risks to the inflation level. And inflation hasn't really taken off, but it certainly hasn't fallen as we've seen oil go up. And the notion of differences certainly across the U.S. economy in terms of how it impacts those in sort of the upper socioeconomic order and those that maybe are closer to the bottom. As many of you know, I live in the state of Oregon. I drive diesel cars. It's over $6 a gallon for me to put diesel fuel in my vehicles. North of $5 for regular gas here. I know it's a better story in the Southeast because you have more, you're closer to refineries, maybe have less gas tax than we do here in Oregon. But that increase, if your gas bill goes up by 20 or 30% and you have to drive to work, this is gonna eventually, if you're not at the top half of that structure, that's eventually going to eat into things. You're going to have substitution effect. You might have to go without on some items. And that will matter, and that will cause some economic impact. So I think the inflation number will be important to watch, but it would be my personal view that I wouldn't expect it to come down by a whole bunch anytime soon. The market narrative on the other side of that, and this feeds into your comment about the new Fed chair, is the potential for productivity gains from the implementation of AI. We have seen some productivity numbers tick up, but it feels like in large part we're still perhaps at the beginning of that. If I use a well-worn baseball analogy, we're probably still in the first inning of where that can go. And then this will depend on, do we get to 9 innings or do we get a rain out in terms of just AI productivity? But it is following similar technology patterns as in the past, ramping slowly perhaps, and then all together at once, where we could see, maybe some advancements. That's how other things like the internet have gone. And the race is always between how quickly can that happen versus how quickly do the stocks reflect what real earnings are. And so I think that's a risk factor. The new Fed chair does have a view that AI will drive a productivity boom. That's a tough job that Governor Warsh is stepping into here as chair, because there certainly is a desire amongst many to take down rates. And there are parts of the economy that are suggesting rates might be too high, that lower rates would help us, grow our way out of this. And those are certainly reasonable arguments. On the other side of the coin, the level of inflation and the general level of prices, cutting rates doesn't necessarily help those items. And, and a key inflationary item, which is housing, housing prices largely reflect a low rate environment, but that means they're very costly. And so we've had some stalling in older folks being able to downsize and younger folks be able to get into their first homes. And rates don't necessarily solve that. Lower rates don't necessarily solve that because sellers will just have to be willing to sell for less to be able to transact those. So I think I think it's a tough job. I think the chair's an important role, but I think he also steps into an environment that's demonstrating there's not necessarily straight consensus thinking. And I think we have to largely remember that the Federal Reserve is a board of people, not just a single chair. And so it will be interesting to watch as he gets to his first meeting and he has his first press release, how that will go. And I think he's also demonstrated, at least through rhetoric historically, that there are some changes he would like to make, including much less forward guidance. And so if he is successful in transitioning the way that the Fed interacts with the public, that could create other opportunities for investors because less transparency, then creates opportunities to make security selection decisions that are independent of regular forward guidance like we see. So I think it'll be interesting to see if he's able to, or if he stays on that path to try and adjust some of the way that the Fed interacts with the public, because that will ultimately have some impacts. I recall early in my career, CNBC showing Chairman Greenspan walking in with his pile of books, and if he was overflowing and papers were falling out, then that was a sign that the Fed's going to move. And if it was a really small binder, then the Fed was going to be taught. So, it might, if nothing else, for good TV, if we got back to those days where we had, we didn't have every Fed speaker speaking every day, might put some more drama back in the marketplace.
Well, that's a good note to end on. So thank you, Travis and Tim and Jane, for being with us today and sharing your insights on the markets and performance and the hedge funds in our portfolio. So thanks to our participants. We hope you found the webinar informational. And just a reminder, we'll be posting a recording of this webinar to my FFTC resources as soon as possible. Thank you, and hope the rest of your week goes well.
Great. Thanks, everybody.
Thanks. Take care.